Hi, I'm Lorna Illingsworth, an independent mortgage advisor for Protection Investments Southampton. Today we're going to talk about what to do if you've had a mortgage declined. There are a number of reasons a lender may decline a mortgage application. One of the most common is credit history. Another major factor is affordability. Sometimes the issue may simply be that the deposit is too low for the lender's criteria or that the overall application doesn't fit their policy. Having a mortgage declined can feel like a huge setback, especially if you've already found a property, started planning your move, or had an offer accepted. But while it can be frustrating, it doesn't always mean the end of the road. Many mortgage declines can be resolved with the right advice and a better strategy. One of the most common reasons for a mortgage decline is credit history. Lenders want to see that you've managed borrowing responsibly in the past. Missed payments, defaults, county court judgments, payday loans, or high levels of unsecured debt can all raise concerns. Sometimes the issue can even be incorrect information on your credit file, such as an old address, duplicate accounts, or a payment marked late in error. That's why checking your credit report before applying can be extremely important. Even if your credit score looks reasonable, making several applications for loans, credit cards, or finance in a short period can be a worry for lenders. It may suggest that you're relying heavily on borrowing or under financial pressure. Multiple hard searches close together can also reduce your score slightly, which may impact the application. Mortgage lenders don't just assess whether you've paid debts in the past. They also need to be confident you can afford repayments in the future. They'll look at income, regular spending, loans, childcare costs, credit commitments, and general household expenditure. Even applicants with strong salaries can be declined if monthly outgoings are too high or if borrowing requested stretches affordability too far. Another common reason is not having a large enough deposit for the lender's criteria. Some lenders offer mortgages with smaller deposits, but the lower the deposit, the fewer options may be available. A bigger deposit can improve loan to value, strengthen the application, and sometimes access better interest rates. Lenders like stability. If you recently changed jobs or are still in probation, have a regular commission, are on reduced hours, or have gaps in employment, the lender may want more evidence before approving the application. This doesn't always mean no, but it may mean using a lender whose criteria better suits your circumstances. Self-employed applicants are often assessed differently because income can fluctuate year to year. Lenders may ask for accounts, SA 302s, tax calculations, or evidence of consistent earnings. If profits have recently dropped or trading history is short, this can affect how much you're able to borrow. This doesn't mean self-employed applicants can't get mortgages, but the documentation and lender choice can be especially important. Large credit card balances, car finance, personal loans, or other ongoing commitments can reduce affordability significantly. Even if payments are up to date, high existing debt may mean the lender feels there is too much financial pressure already in place. Reducing balances before applying can sometimes make a meaningful difference. Sometimes the mortgage is declined because of the property rather than the applicant. The lender's valuation might come back lower than the agreed purchase price, meaning a larger deposit is required. Or the lender may be uncomfortable with the construction type, lease terms, location, nearby commercial premises, or conditions of the property. Different lenders have different appetites for different properties, so one lender saying no doesn't always mean every lender will. An agreement in principle is not a full mortgage offer. It's usually based on initial information provided at the time. Once the full application is submitted, the lender carries out deeper checks. That could include updated credit checks, affordability assessments, document reviews, and a property valuation. That's why some applicants are surprised to be declined later in the process. If you've had a mortgage application declined, the first step is not to panic and not to rush into multiple new applications. Too many applications in a short space of time can make matters worse. Instead, find out the exact reason for the decline. Once you understand that, you can create a clear plan to improve the next application. That might mean correcting credit file errors, reducing debts, saving more deposit, waiting until employment is more established, or it could just be using a different lender. Every lender has different criteria. Some are stronger with self-employed income, some more flexible on credit history, and others more open to unusual property types. A mortgage advisor can help match your circumstances to the right lender and reduce the risk of unnecessary declines. Mortgage decline can feel disappointing, but it often means the application wasn't right for that lender at that moment in time. Understanding the reason is the key to moving forward successfully. With the right strategy, many people go on to secure a mortgage after an initial refusal. If you've had a mortgage declined and would like to discuss your next steps, please call us on 02380 668 407 or visit our website.